What if I told you that investing just $500 every single month could turn you into a millionaire? Not in some fantasy scenario, but using verified data from November 2025. The math is simple. $500 monthly for 35 years at 14% returns equals $1.63 million. But here's what nobody tells you. There are multiple proven paths to get there, and I'm about to reveal every single one with real performance data, not hype. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let me be clear from the start. This isn't about get-rich-quick schemes or secret strategies that Wall Street doesn't want you to know. This is about boring, reliable, mathematically sound portfolios that have created more millionaires than any other investment approach in history. And the verified data through November 2025 proves these strategies are still working today. So what actually makes a millionaire portfolio? After analyzing decades of data and comparing hundreds of investment approaches, 4 characteristics separate the winners from everything else. First, globally diversified index funds that hold thousands of securities. Second, ultra-low expense ratios between 0.03 and 0.07%. Third, strategic asset allocations matched to your specific risk tolerance and time horizon. And fourth, the discipline to ignore market noise and keep investing regardless of what's happening in the headlines. Let me show you why expense ratios matter more than most people realize. Take $10,000 growing at 10% annually for 40 years. With a 0.03% expense ratio, you end up with $452,593. With a 1% fee, you get $262,040. That's a $190,000 difference from less than 1% in fees. This is why actual millionaires ruthlessly minimize costs. Now let's talk about recent performance because I want you to see these strategies are working right now, not just in historical backtests. The S&P 500 returned 25.02% in 2024 and 15.45% year-to-date in 2025 as of November 7th. These aren't hypothetical returns. This is verified data. You can check yourself. The first proven strategy is the Bogleheads 3-fund portfolio, and it's beautifully simple. 60% in domestic stocks using VTI, 20% in international stocks using VXUS, and 20% in bonds using BND. This combination holds over 11,000 global securities through just 3 positions. Historical data from 1997 through 2019 shows this 60-40 allocation delivered 8.13% annualized returns with manageable volatility of 8.03%. It survived the 2008 financial crisis, the 2000 dot-com crash, and every market turbulence in between. Here's the wealth-building math. A $6,000 annual contribution growing at 9% reaches approximately $1 million in 35 years. The beauty of this approach is its resilience. When stocks crash, bonds stabilize. When international outperforms domestic, you're positioned. The expense ratios of 0.03 to 0.05% mean virtually 100% of returns compound in your account. This is the strategy for investors who want reliable wealth accumulation without excessive risk or complexity. The second strategy comes from the world's most successful investor. Warren Buffett consistently recommends 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. His confidence is so strong that his estate directives specify this exact allocation for his family's wealth. The S&P 500 has delivered 10.5% average annual returns over the long term, with recent 10-year data showing 13.98% annualized. An investor contributing $400 monthly to this strategy at 11% average returns accumulates approximately $1.3 million over 40 years. Buffett's genius is recognizing that complexity doesn't improve results. 90% exposure to America's 500 largest companies, rebalanced annually with 10% bonds for stability, has outperformed the vast majority of professional money managers over any meaningful time period. The third strategy combines growth and dividends through a 50-50 split between SCHG and SCHD. Verified data confirms exceptional performance. SCHG delivered 24.77% in 2024 with 16.85% annualized 10-year returns. SCHD delivered 16.43% in 2024 with 11.47% 10-year returns. According to Portfolio Visualizer data since 2016, this combination has delivered approximately 1.5% annualized outperformance versus the S&P 500 with slightly reduced risk. The psychological advantage here is elegant. During growth markets, SCHG outperforms dramatically. During dividend-friendly markets, SCHD provides stability. The 50-50 rebalancing naturally implements buy low, sell high discipline without emotional decision-making. You're forced to sell some of whichever fund performed better and buy more of the underperformer, which historically has enhanced returns while reducing volatility. Now let's examine pure S&P 500 strategies because the data is remarkable. VOO, Vanguard's S&P 500 ETF, represents the gold standard. Verified data through November 6, 2025 shows VOO delivered 24.98% in 2024 and 15.45% year-to-date in 2025. Over 10 years since inception in September 2010, VOO has delivered 13.98% annualized returns, with cumulative returns of 591.2%. The expense ratio of 0.03% is among the lowest possible. VTI offers the broadest exposure, holding approximately 4,000 U.S. stocks across all market capitalizations. Verified data shows VTI returned 23.81% in 2024 and 14.71% year-to-date in 2025, with 10-year annualized returns of 13.16%. For investors who want total market exposure beyond just large caps, VTI provides comprehensive coverage. Vogue concentrates on S&P 500 growth stocks and delivered 35.89% in 2024 and 20.46% year-to-date in 2025. 10-year annualized returns hit 15.96%. The trade-off is higher volatility, with a 32.73% drawdown during October 2022. Let me show you the mathematics of wealth creation because understanding these numbers changes everything. A 25-year-old investing $500 monthly at 13.98% grows to $1.63 million by age 65. At 16.85% returns, that same contribution becomes $2.59 million. Starting at 35 instead of 25 with identical contributions reduces these to approximately $590,000 and $900,000 respectively. That single decade of delay costs over $1 million in opportunity cost. The wealth-building journey has three distinct phases. Phase 1 is the first $100,000, typically taking 5 to 7 years. During this phase, your contributions dominate returns. A $1,000 monthly contribution at 10% returns accumulates approximately $78,000 from contributions and $22,000 from returns over 6.5 years. Focus here is maximizing savings rate rather than return optimization. Max out your 401k contributions of $23,500 in 2025 and Roth IRA contributions of $7,000. Phase 2 is the acceleration from $100,000 to $500,000. Once your portfolio exceeds $100,000, annual returns become material. A $100,000 portfolio at 12% generates $12,000 annually in gains, equivalent to $1,000 monthly contributions. During this phase, typically years 5 through 20, compound growth accelerates dramatically. This is also when market volatility tests your discipline most severely. Phase 3 is the final push from $500,000 to $1 million, and it often surprises investors with its speed. A $500,000 portfolio at 10% annual returns reaches $1 million in approximately 7.3 years without additional contributions. With continued $500 monthly contributions, this timeline compresses to roughly 6 years. Many investors prematurely reduce stock allocation during this phase, afraid of setbacks close to their goal. However, reducing from 80% to 60% equities typically costs over $100,000 in foregone returns. Now let's talk about risk reality, because I need you to understand what to expect. Historical data shows significant drawdowns are inevitable. VUO's worst drawdown was 33.99% in March 2020 during COVID. VTI hit 35%. VUOG dropped 32.73% in October 2022. These drawdowns lasted 6 to 12 months before substantial recovery. Here's the critical insight. Investors who maintained discipline and continued contributions during these periods dramatically enhanced their wealth. The 2020 example illustrates perfectly. The market crashed 33% in March. Investors who panic sold locked in permanent losses. Investors who held or bought the dip achieved exceptional gains as the market recovered to new highs within months, and then surged through 2021. Rebalancing forces disciplined action. When your allocations drift 5 to 10% from targets, you automatically purchase underperforming assets currently cheap and reduce outperforming assets currently expensive. The 2022 example shows this power. Investors maintaining 80-20 stock bond allocations who rebalanced bought stocks at depressed 2022 prices. The subsequent 2023 through 2025 rally multiplied these discounted purchases. Let me reveal the 3 wealth destroyers that prevent people from reaching millionaire status. First is performance chasing. The single most destructive behavior is selling stable performers to chase last year's hottest investment. Investors who replaced diversified portfolios with concentrated bets on cryptocurrency or individual growth stocks during 2021 through 2022 experienced devastating losses. Meanwhile, boring VOO and VTI holders recovered fully and surpassed previous highs. The second destroyer is fees. A 1% annual fee difference consumes 20 to 30% of total portfolio value over 40 years. Average actively managed funds charge 0.6 to 1% versus 0.03 to 0.07 for index funds. That $190,000 difference I mentioned earlier, that's real money that never compounds in your account. The third destroyer is market timing. Missing just the 10 best days in the stock market over 20 years reduces total returns by approximately 50%. These best days often occur during volatile periods, making them impossible to predict. The solution is time in the market rather than timing the market. Dollar cost averaging, investing fixed amounts regardless of prices, automatically buys more shares when prices decline and fewer when expensive. Your implementation blueprint starts with age-based allocation. The rule of 110 suggests subtracting your age from 110 for stock allocation. A 30-year-old gets 80% stocks, a 50-year-old gets 60%. However, analysis of actual millionaire portfolios reveals most maintain 80% stock allocations if they have decades before retirement because equity volatility matters less over 30 to 40-year horizons than average returns. Young investors aged 20 to 40 benefit from maximum stock exposure, 80 to 90% equities with minimal bonds. Each dollar invested at 25 at 12% annual returns grows to approximately $93 by age 65. That same dollar invested at 55 grows to only 2.48 over 10 years. This mathematics explains why maximizing equity exposure when young dramatically shortens the timeline to millionaire status. Here's your credible path forward, backed by verified November 2025 data. Multiple strategies exist. The 3-fund portfolio for balanced diversification, Buffett's 90-10 for concentrated simplicity, the SCHG-SCHD combination for growth plus income, or pure market exposure through VOO or VTI. All share common threads: globally diversified index funds, ultra-low expense ratios, strategic allocations, consistent contributions, and discipline to ignore speculation. The verified mathematics are compelling, but they require one thing from you: action today, not tomorrow. Every month, you delay costs thousands in compound growth. A 25-year-old starting now reaches over $1.6 million. Starting at 26 reduces this by approximately $50,000. Starting at 30 costs $250,000 or more. Your path to millionaire status requires neither genius nor luck. It requires discipline, consistency, and patience to let mathematically sound strategies compound over decades. As verified data from multiple fund families and decades of market performance confirms, this approach has worked, is working, and will likely continue working for investors willing to commit. The only question is, will you be one of them? If you found this breakdown valuable and want more data-driven wealth-building strategies, smash that like button right now. Drop a comment below telling me which portfolio strategy you're choosing, the 3-fund approach, Buffett's 90-10, or the SCHG-SCHD combination. And if you're serious about reaching millionaire status, subscribe and hit the notification bell so you never miss actionable investment insights backed by real verified data. Your future millionaire self will thank you for taking action today. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.